Hello, everyone. Listen, today we have a great episode for you, and it's going to be on the first position HELOC. It's been brought to my attention that I need to explain what a first position HELOC is and how it can drastically eliminate all mortgages, all loans, the car loans, whatever loan that you have, student loans. If any loan you can name, you can get rid of it through this first position HELOC. I would like to show you how powerful this first position HELOC is, okay? The fact of the matter is, in essence, homeowners were using their HELOC as both a mortgage against their home and as a checking/savings account into which they deposited all of their money and paid out all of their expenses. Now, HELOCs are also calculated on daily interest, meaning that the interest charged is only calculated, watch this, on the actual daily loan balance. So each time the homeowner deposited their income against their HELOC balance, that money would automatically be subtracted from the daily loan balance that they owed. Now, as a result, each time homeowners deposited income against their HELOC balance, it allowed more of their regular monthly mortgage payment to be credited toward principal and far less toward interest. Why? Because their daily loan balance was less. Additionally, since HELOCs work very similar to a normal checking and savings account, meaning you get cards with it, right? This approach gave homeowners tremendous freedom. The homeowner could literally deposit money against their HELOC balance, saving them both time and interest on their mortgage. And like a standard checking and savings account, let me tell you, HELOCs came with checks, some of them, right? Debit cards, and online access for any time they needed to pay their monthly expenses. Furthermore, instead of having the remaining money or the money they had left over after paying monthly expenses sitting in an actual checking and savings account doing nothing, right? Earning them close to zero interest, actually losing money because of inflation tax, okay? That money was now sitting against their HELOC balance until they needed it for future expenses. Now, this kept their HELOC balance low for as long as possible and further canceled out daily interest charges that would normally be charged on their line of credit balance, okay? That's called money working for you. After looking into this method a little further, it became quite clear to me that this may not be the best approach for all mortgage clients. Okay. While some homeowners in Australia and even the UK were accustomed to having a variable interest rate mortgage, many homeowners in the US are not. So in order to implement this approach in the US, homeowners would have to refinance their entire fixed interest rate first mortgage amount into a variable interest rate HELOC. Now, while that may be just fine when rates are low, it can actually potentially spell out some serious consequences if or when interest rates increase. The age-old saying of what goes up must come down applies in this scenario, except in reverse. What goes down must go up. Now, you may be a mortgage client that has a nice, low, fixed interest rate mortgage. There was no way that I was going to advise you to refinance your entire fixed mortgage amount into a variable interest HELOC. This could actually potentially seriously affect your finances in an adverse way. So that's why I found a solution, right, to ensure that you don't have to use a first position HELOC if you don't want to. However, if you have one, no worries, okay? This is how it works. Let's start out with what you can see on a typical mortgage. Now, this one is $300,000. Okay, we switched it up. Usually we use $200,000 and 6% interest. We're switching it up. This one's $300,000, this mortgage, at 3%. Okay, this is what you can expect in your first year. All right, $8,914.32 yearly payments to the mortgage. Okay, yearly payments to the mortgage. $8,914.32. What is that? That's right, year to date for the mortgage. $8,914.32. $15,177.72 for P&I. Okay? And the same goes to right there for year to date. Now, this is 1 year, folks. 1 year. The second year, what do you have? $8,723.85, okay, for the payment, right? And $17,638.17, right, year to date. And then we have the same for the P&I, okay, as well as the principal and interest, as well as the $30,355.44. All that is doing is just adding these together. Now, that's what you can expect when you have a mortgage. And that number's only going to go up, okay, year after year after year. I want to show you what happens when you have a first position HELOC. Watch this. Pac-Man eating your house. Uh-oh. What is that about? Let me tell you what it's about. It's about the first position HELOC. That's what it does, folks. It takes you $300,000 mortgage at 3%. Remember what the percentage was on the first year? What was it, 57%? Okay, that doesn't sound like 3% to me, all right? The first year was 57%. The second year, the first year was like 58%. The second year was like 57%, okay? Or thereabouts. 57%. And so if it's 57%, right? If it's 57%, where did they get the 3% from? Because it's amortized. That's right. They go by an amortization table. And so essentially what a first position HELOC does is it eats up your mortgage. So it replaces your mortgage so that you're no longer paying that astronomical amount of money. My word, okay? It's amortization. That interest that could be going into your pocket is going into the bank's pocket when you have a mortgage, okay? Let's go ahead and ask for first position HELOCs, huh? Let's do this. Let's get banks on the line, and I'm going to make a video about the certain banks that you need to talk to in order to make sure that you have the best first position HELOC possible. We're going to go through the questions. We're going to go through the banks so that you can have the advantage over the banks and you can have your own personal bank. Now, the system that I utilize, I use advanced lines of credit, meaning that I show my clients across the board. If they have HELOCs, that's great, but I have advanced lines of credit that go throughout the different spectrums of the credit lines. Okay, not only HELOCs, but commercial lines, credit cards. We're talking about all kinds of lines of credit, personal lines of credit, business lines of credit, so that they can do this to their house. All right, you understand? The first position HELOC actually eats that mortgage up so that now you're not paying that astronomical amount. Let's say you have the HELOC at 21%. CJ, that's kind of high. Yeah, but it's simple interest. Never forget that. That's what you ask the bank. Is yours calculated? Is your HELOC calculated on simple interest or amortized? Absolutely. Ask for the manager, right? Because the personal banker may not know. Okay, and they may know. All right, let's give them the benefit of the doubt. All right. So again, this is what the first position HELOC does to the mortgage. It eats it up so that it's no longer a mortgage. But now your HELOC is in control and you can use that as your new line of credit, paying down that house in astronomical amounts. Okay, it all depends on what's left in that HELOC. All right, absolutely. folks, this is the way to go. And if you don't have lines of credit, don't worry about it. Get in touch with me. I want to set up a velocity banking strategy that you can use even if you don't have any lines of credit, okay? And if you have lines of credit, that's great. Get with me. I want to set up, right, a velocity banking strategy. You know, I have someone that's going to be out of debt in 3 years. I am looking so forward to it because it's going to be amazing. The kinds of banking tools that we pull out and the kinds of timing, it's all about timing, that we hit that principle with, okay? If they don't want to do the first position HELOC, that's great. It's all about timing, and we can show you that. Just let us know, all right? CreditWiz@investorpro.org. This is the first position HELOC in a nutshell, folks. That's what it does, okay? Eats up that mortgage, it really does. And we want to do the same thing for you in all of your debts, all right? God bless, and you have a great night.